Welcome to the ROI Masterclass, the podcast where vision meets strategy and bold moves create measurable results. I'm Liat Siegel, interior designer and ROI strategist with 17 years of experience. I help businesses transform properties and ideas into high-performing assets. This show is specifically for real estate investors, hospitality operators, and boutique developers who aren't afraid to take risks, challenge the status quo, and demand a return on every decision they make. Each and every week, we talk with innovators and leaders across industries about the strategies and the insights and really all the unconventional thinking that turns potential into profit every single time. If you believe that smart design, decisive leadership, and strategic risk are the keys to real ROI, you're in the exact right place. Let's dive in. Today on the show, I'm excited to welcome Matt Picheny, a multifamily investor, coach, and author who has managed and acquired more than 12,000 apartments across the U.S. He's been named the best multifamily investment coach by the American Apartment Owners Association and wrote the #1 best-selling book, Backstage Guide to Real Estate. Beyond real estate, he's also a Broadway producer, co-producing Tony Award-winning shows like Moulin Rouge and American Utopia, and even investing in Hamilton and Wicked. His mission is to help people achieve financial freedom, create lasting impact, and pursue their biggest dreams. Matt Picheny, welcome to the show. Thank you so much for joining us.
Oh, thank you for having me. It's a pleasure to be here.
So tell us about your journey, how you got here, and why you love what you're doing.
Yeah, I started off, I grew up in Orlando, Florida, moved to New York City to pursue a career in theater. And I was a professional actor for about 5 years. Had a lot of fun doing that. But this was also in the mid to late 90s when the .com craze was among us, right? And I started tinkering around with website development, ended up having my own boutique agency, web development agency, building websites. 2001 came along, the .com bubble burst. All of my clients were going out of business. And I had been living in an apartment that I was told I had to move out of because the owner needed to sell the place. So I needed to find a new place to live. And also a job because my business had completely imploded. Luckily, Showtime, the cable television channel, they were a client of mine. They offered me a position to come in-house. So I did that. And instead of finding a new place to rent, I actually found an apartment to buy way uptown in Manhattan, up in an area called Washington Heights. Not what a lot of people think of when they might think of Manhattan, but it's there, but it's all the way on the tip of Manhattan. And I bought that place, and about a little over 2 years later, I ended up selling that apartment, and I more than quadrupled my initial investment into it. Yeah. So that was a big eye-opening moment for me where, I was making a good salary at that point. I was making six figures, and this was back in 2003. But that one transaction was more than an entire year's worth of salary. So I was like, all right, how can I make that happen again? So I spent the next 15 years or so trying to figure out how to do that. And I did everything. I did fix and flips. I did vacation rentals, all that kind of thing. And then I stumbled upon something called real estate syndication, where investors can pool their money together to go after assets that they couldn't get on their own. So I was able to start buying large apartment complexes. And so that's what I've been doing since 2016, really, is buying large apartment complexes strategically in different locations in the United States. And it's been really great. It's been a fun ride.
Wow. What a story. What a journey. What was the biggest lesson in terms of ROI that you've learned doing so many different properties, and is what you're doing now, do you feel like that is has the potential for the biggest ROI?
Yeah, I started doing something, I think just out of both necessity and out of instinct, from my very first real estate investment. I talked about the property that I had bought up in Washington Heights. Now that was a part of a co-op building. So as a member of the co-op building, the building itself was a bit dated, right? It had been built in the 80s and really hadn't been updated since. And so it looked pretty shabby. And I was talking with some people who were on the co-op board. They formed a committee, and I was a member of that committee to renovate the property. So we renovated the lobby, we renovated the hallways and the elevators, and made the property look a lot nicer. I also did renovations inside the unit. The apartment that I had was run down. I mean, there were some cracks in the walls. I mean, nothing that, it was all sort of cosmetic. There was nothing structurally wrong with it, but like it needed to be patched up and painted and things like that. So we did that. And by doing that, really increased the value of the property. Now, over that 2-year period, also real estate in New York increased a bit. And also the neighborhood that I was in was sort of on the upswing. They opened up shortly after I moved in, they opened up a Starbucks around the corner, right? So there was
right there. I lived right in the corner. Yeah.
Okay. So what, on 181st?
Yeah, 181st, and I forgot the name at this point, but
Fort Washington, I think.
Yeah, Fort Washington. Yeah. In the building right above the Starbucks.
Oh my goodness, that's funny. Yeah. So I was up a little higher. I was on Overlook Terrace, so like 190th, like right near sort of the entrance to Fort Tryon Park. Just down a little ways, there's this little block or two called Overlook Terrace. Anyway, so by making those renovations that we did, and also having the community sort of being, better neighborhood, I saw a lot of value increase on my property. And that's been a formula. I didn't even realize that I had done that, but I did that on the next apartment that I bought as well. I made improvements on a lot of improvements on the unit, and actually joined that co-op board and ended up being the president of the co-op board at one point. But we made improvements to the building, security improvements, and just a lot of different things, renovations, also the lobbies and the hallways and all that. And so by making those improvements, I saw the curb appeal went up on the properties, and the value of the properties increased. And that's something that I do to this day on the large apartment complexes that we purchase. We purchase properties that have usually been, a bit neglected, and we'll go in and we'll make improvements to the common areas, whether that's hallways or pools, pool furniture, landscaping, those kinds of things, the clubhouse, fitness center. We'll renovate interiors of units by getting rid of carpet and putting in, plank flooring, by putting in backsplashes in the kitchen, changing. A lot of times the paint is sort of that old two-tone kind of beige paint, and we've been going a lot with a gray color scheme, right? And gray walls and white baseboards. But we'll make improvements, countertops, those kinds of things. And by doing that, it helps improve the value of the property. And then also when there are things that we can do to help create community or foster community in the area, or do things that help the surrounding area, we do that as much as we can as well, because that helps lift the value of the property and also makes life better for the residents who live there. I mean, I feel fortunate that I'm able to be in a profession where I can make people's lives better and make money in doing so. I look at all of these opportunities as win-win situations where we improve the quality of life for the residents who live at the properties. We also improve our bottom line and make money for our investors as well. So we're kind of helping everybody together.
Yeah, it's absolutely a win-win. I really do feel what you're saying is definitely indicative of that perceived value equates to actual value. And, sometimes people get it and sometimes they don't. But I think that the investors that do, they see the uplift. They see their NOI improve, right? They see that when people feel taken care of and they feel their quality of life is improved, they'll be willing to pay for more. They'll be willing to stay longer, right? And all of these things really help ultimately improve the spreadsheets at the end of the day, to know if the property is worth it or not, if you're making money and other investors that are investing in the property with you are, that they made a good deal and they made a good decision investing with you.
Yeah, and a lot of times it also helps residents feel a little more pride in where they live, and then therefore they actually take care of it a little bit better, which is nice and reduces our bottom line. Our maintenance costs go down often because of that. So Yeah.
Absolutely. So what are the main factors when like looking at a property and deciding if it's a good property to invest in or not? What are your key factors? What are you looking for?
So a lot of different things that we're looking at. We take a deep dive into the financials of the property, and just by looking at the numbers on a property, I can tell how it's being operated and whether it's being operated efficiently or not, or too efficiently. What we don't want to do, you can be a slumlord, right? You can cut services to your property, reduce your expenses, and make money as an investor. But I think you're lowering the quality of life for people who are there. So we try to actually make money by making things better. And so we look at how things are being operated. We also take a look at what's going on in that market to try to understand where things are moving. A lot of the properties that we are purchasing are properties that are not operating at their best and highest use. Right. And making improvements. We'll buy properties where the rents are some of the lowest in the market, and the property itself is actually one of the grungiest in that market. Then we'll go in and we'll make renovations, and we will increase it up. We don't bring it up to the top of the market. We just bring it to the middle. We're just bringing it up from the very bottom to the middle. And in doing that, we're increasing the income enough where it makes a really nice return on investment, but makes it a better property for everybody to live there. So we're looking at what's going on in that market. What are the surrounding properties looking like? What does this property look like? And what is the opportunity there? What can we emulate in that marketplace? If we know that there's a property that looks a certain way and is achieving certain rents, it's pretty easy to deduce that if we're right next door to it, if we make our property look the same way or better, we should be able to get the same rents as the other property or better. So
Absolutely.
It's not really rocket science.
Yes,
it's just really getting to know and understand the market. That's why we focus on specific markets and get to know markets intimately to be able to understand what's possible.
I love that so much, because that's precisely what we do when we have a new client come on board. We'll do an audit. Right. We'll do an analysis. Sometimes the word audit scares people, but it's really an analysis to determine, what's the potential? How much money are they leaving on the table? Right. People will say, okay, how do you make this look beautiful? I'm like, wait. We're not looking at how to make it beautiful first. We want to know strategy, right? What do the comps say? How are other properties performing? What kind of strategic upgrades can we make in order to maybe surpass the comps of the other properties and increase the value here, right? And increase the quality of life for the residents. Maybe there's another revenue stream that we can build in that we're not, taking into consideration. So really understanding, like you're saying, the market, the micro market, right, of that specific location, and what the other comps are saying, and what creative ways can we increase revenue and really make an impact for our investors. That's what kind of is very exciting, because you're constantly up leveling it and taking it to the next stage, the next level. So tell me about the misconceptions about passive real estate investing. What are the biggest things that you see people making a mistake?
From a passive investment perspective, because I work with two types of people. I work with passive investors. I also work with active investors. I'm an active investor myself. I teach people how to syndicate deals. And, misconceptions about that, I could talk for ages. But when it comes to misconceptions around passive investing, I think it is passive, but I think you need to to be successful, I think you need to have a certain level of education in the real estate world to really be able to effectively vet these deals. And I'm not saying that you need to take all, college level courses on it or something like that. But I see people who are busy professionals. They just hear that real estate is good, and they somehow meet somebody or something, and they tell them, oh, it's this great investment, they're going to make all this money, and they just kind of blindly throw money at a investment. And I think that can be very dangerous. I think it's important for investors to know the fundamental things that they need to look at to determine if that's the type of investment that they want. And I wrote a book that goes into detail on all that. I also have free guides on my website about it as well. But just to recap it at a very high level, there are three things that are three categories that passive investors need to look at. First and foremost, who is the person or people who are putting the deal together? They're known as the general partners or the sponsors. What is their track record? What have they done in the past? What is their sort of DNA? What do they do? What are they interested in? How do they operate their properties? That kind of thing. Are they, as we were talking earlier, someone who's just trying to cut expenses as much as possible to squeeze every last dime out of a property? Or are they, which is fine if that's your investment thesis, or are they somebody who actually wants to go in and make improvements to properties? Like what is their, how are they approaching it? That's number one. Secondly, the second thing that you want to look at as a passive investor is the market. When I say market, I mean location. Where is the property located? And not just looking at the overall, for the example of New York, just because we were talking about New York earlier. Okay, it's in New York. Okay. Or is it in New York City? And then if it's in New York City, okay, well, what borough is it in? Okay, it's in Manhattan. All right, well, is it in Washington Heights, or is it in Midtown, or is it down in Tribeca? Yeah. Because all of these different, things are really, really important. They say the three most important things in real estate are location, 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 right? So where exactly is the property located, very specifically, and what's going on in that market? And are things, is this on the path of progress? Is it in a part of town that's not so great, that's on its way up or on its way down? Those kinds of things. And then the third thing is the actual business plan for the property itself. What are they looking to do at the property? Are they looking to make improvements? What are the rents now? Are they trying to increase rents? What do those rent increases look like? Is that, within reason historically, with forecasts? And, there's many, many other factors besides just the rents. But that's just as an example, one of the things that you'd want to look at it on the property level to sort of vet whether this makes sense or not. And as I mentioned, you can get a bit deeper into all these things, which, like I said, I have a guide on my website that you could download, or my book has a lot of detail on that, how to really understand what the business plan is. The great thing about passive investing is if you do the right due diligence up front, you vet the person, you vet the market, you vet the deal, and you like it, well, then that's it. You put your money in, and hopefully they operate it well. Hopefully it makes money and it gives you nice returns, and you don't have to be involved in the day-to-day. But I do think that there is some upfront work that needs to be done for you to know that you're making the right decision at the beginning.
I think that what you're saying is that there's no such thing really as passive investment. It sounds like, you really need, and I've heard other investors say this before, you really need to know what you're doing. You can't just put money in and expect that it's going to print.
Yeah, well, I think that it is passive after you've done the work, right? And so in the book, I define passive investment as an investment where you don't need to, that may require some upfront work, but there's no ongoing work that needs to be done. And a lot of these, real estate syndications, the ones that I run, that I teach people how to run, and the ones that I invest in passively, I've invested in a lot of passive investments. You mentioned earlier in the intro that I've invested in over 12,000 apartment units, which is true, but about 7,000 of those are deals that I've invested in passively. About almost 5,000 doors are ones that I have control over, that I've been a general partner on and owned and operated, right? Partial ownership, because we'll bring 50 people in and we'll buy, 100 unit property. So once that upfront work is done, though, a lot of these investments are 5 to 7 years. Once that upfront work is done, that's really it. And then, hopefully the person who's running the deal is sending you reports on some sort of regular cadence. A lot of times we start off sending reports on a monthly basis, and then a few years into the deal, if it's running smoothly, there's not so much to report on a monthly basis, and we'll start reporting on a quarterly basis, and hopefully sending distributions on a quarterly basis as well, sending money to investors. But there's not that much that needs to be done. That's why I like investing passively. That's why I've invested in over 7,000 doors as a passive investor, because I can't find every good deal that's out there. I can't intimately know every single market. We talked earlier about how important it is to understand understand a market and learn a market. I can't do that with every market in the United States. But if I know that there is a certain person who has operates in a particular market and they have a good track record and I've heard good things about them, then potentially I might invest in one of their deals. And then again, I'm vetting them, I'm vetting the market, I'm vetting the deal itself, and then I give them money and then I don't do anything. And hopefully they send me money back. Yeah.
And you're printing money.
Hopefully they're printing money and sending it to me.
Exactly.
Yeah.
What kind of amenities do you see the biggest impact in terms of ROI?
It's hard to say. It does vary from market to market, but there are anything that we can do where we can charge a premium for residents who want that specific thing can be very helpful. So one of the things that I love doing is making private backyards. You're talking about a garden style apartment community where you've got 2 or maybe 3-story properties. On the ground floor, there's a lot of people who will have a patio, but the backyard is sort of open and connected with everybody else. Well, if you can put some fencing around that, well, now they have a private backyard. And the people who seem to really love those are dog owners. And so with dog owners, well, first off, we can charge pet rent, which helps our bottom line because we charge a little extra for people with pets. But the other thing is they love having that fenced in backyard because in the morning, if the dog needs to do its business, you can sort of just open the sliding glass door and let them go out in the backyard and run around. You don't have to necessarily take them for a walk. So they love it. And you could charge a premium. You could charge, in some cases, we're charging $75 per month of additional revenue. So if you think about it this way, if you have $75 a month in additional revenue from the backyard and then $25 a month for pet rent, you're talking about an additional $100 per month. Now, if that's for a full year, 12 months, that's $1,200 for the month. And let's say you're in an area with a cap rate of 5%. That's an additional $24,000 of value you've just added to your property.
For one unit or for across all?
That's one unit. That's one unit, right? $100 a month for a full year. That's $1,200 per year. You've increased your cash flow by $1,200. Now, maybe the cost to put that fenced in yard is, somewhere between $1,000 to $3,000. So you're looking about a payback in about a year or two. But the way that commercial properties, all commercial properties actually are valued is by looking at the net operating income, the NOI that you mentioned earlier, income minus the expenses. Well, there's no expense. There was the upfront cost, which is a capital expenditure, which is categorized differently. There's no ongoing expense for that fence. Hopefully you've got a good fence, maybe composite materials, so you don't have to paint it and there's no maintenance. Okay. So you have that fence. That's giving you an additional $1,200 to your NOI on a yearly basis. You take the NOI, you divide it by the cap rate. That's how all commercial properties are valued. So if you take $1,200, you divide it by 0.05, 5% cap rate, you're looking at $24,000 of increased value. Now, if you can do that on 100 units, right, then you're talking about $2.4 million. Now, being realistic about it, you probably don't have 100, depending on the size of your property, you might not have 100 units that have a patio. And if you have a 100-unit property, you might have 50% if it's 2 floors. Maybe if you have a 2 to 300 unit property, you might be able to go ahead and make 100 fenced in, private yards with people who have pets that move in, and boom, you just increased your value by 2.4 million. Cap rates vary, so that's going to change the equation. The amount that you can actually get for these things could vary, but on average, that's what we're seeing. And so it really helps our bottom line.
Mind-blowing. The small changes, the small strategic changes that make such a massive impact.
We do things with laundry. Also, we do things with valet trash. We do covered parking, reserved parking. There's all kinds of different ancillary income that you can create at a property that's really going to help with that bottom line.
Amazing. So if somebody wanted to get into real estate now and real estate syndication, active or passive, what would you say to them? What would be their first few steps?
Well, I personally think right now is a great time to get involved. Real estate was very hot a couple of years ago. It cooled off quite a bit. But indications right now seem to show that for the last There was a report that came out this week that for the last 4 quarters, commercial properties have stabilized and started ticking up a little bit, which makes us think, and this is all thinking, nothing's 100% accurate, but it looks like the bottom of the real estate market was probably in Q1 of 2024. So maybe Q2. We think things are on the upswing. So I think now is a great time to get involved. I think the first and most important thing is to get yourself educated, whether you want to be active or passive. Obviously, if you want to get active, getting very educated, joining a group. I have a mentorship group, but there's lots of ones that are out there. Joining a group can be really helpful. Getting some sort of, structured education besides just watching free videos on YouTube and downloading PDFs. I got tons of those out there too for free for people. But if you're really serious about it, I would recommend spending a couple bucks and really getting yourself educated. And the same thing for if you're looking to passively invest. I don't think you need to be as educated as those who are actively doing it. But getting that education, I think, is the first step so that you can start to understand a market, understand what's going on, vet operators, look at business plans with a certain amount of scrutiny, so that you can decide if it's the right investment for you and your investment goals.
Amazing. Where can our listeners learn more about you and find all of your work?
Yeah, just head on over to Picheny.com. It's Picheny.com. I'm sure you'll link to that in your show notes, but that's where I've got tons of free resources, including a monthly newsletter, which has got lots of information on what's going on and links to videos, free educational videos, and all kinds of stuff. So I would check out Picheny.com to learn more.
Wow. Thank you so much, Matt. It's been such a pleasure speaking with you, and I can't wait to see what's next.
Thanks for having me on, Leah. It's a pleasure.